Thank you very much. I feel you being here at the premises of the European Banking Federation, I should also welcome the panel and the audience. And I think it makes me feel comfortable to shamelessly exploit this opportunity to talk about the EBF's main messages of our position. But I feel before I start and endeavoring on that, I think it's maybe good to bear in mind that the European banking industry has a vested interest in the financial stability framework and the prudential regulation that these other banks are and themselves are well capitalized and have sufficient liquidity and are subject to enhanced supervision. Because after all, it's banks that pay also for the failure of other banks, and be it as counterparts or being the main payees of the deposit insurance fund or the resolution fund, potentially bail-in, or just being part of the economic downturn. I think as an actor makes financial stability, of course, a very big priority for banks. So I think it's also worth noting that I saw today the monitoring exercise from the Basel Committee and the EBA was published today, and it's very positive to note that Tier 1 capital increased since the crisis from 7.7% to 13.8%. The liquidity coverage ratio is being met at 140%, and NSFR at 112, and we have to recognize the huge progress of the SSM and the single resolution authority being there, having enhanced supervision and centralized the resolution process. So one of the concerns of banks that we hear most is the eventual return to profitability. I think we still acknowledge that return on equity is still falling short of the cost of equity. I saw yesterday also the financial stability report that the shadow banking sector is growing by 7.6% since 2016. So I think that there is a strong reason for us to shift our key concerns for the EBF, which is really to focus on jobs and growth, and to achieve a level playing field for European banks, be it with international competitors or within Europe itself. So the recalibration, and specifically the calibration of MREL and TLAC is one of the most important issues for our members, and we would welcome caps being set, especially TLAC being really the highest form of bail-inable liabilities that has been created. I think in view of ending too big to fail should be hopefully the upper limit that we like to see. But in general, I mean, we'd like to see MREL and TLAC being set with in mind of the resolution planning of banks to set it with the view of the balance sheet after resolution for a bank, which could by all means be smaller. So I think we've made some proposals to limit the guidance to exclude systemic risk buffers or the countercyclical buffer. So we hope that this argument can still be taken on board in the final negotiations. I mean, we would agree with a limit to the flexibility or framing at least the flexibility of the calibration in that respect as well. And certainly we see in the Council some developments setting benchmarks requirements for non-G-SIBs, also for subordination of debt. And I think we think still the idea of MREL, I agree with Mr. Hartmark that the idea that something is subordinated or eligible debt doesn't preclude from having a broader recognition of bail-inable instruments that are out there. So we support that. Another core theme of the EBF is to enable banks to finally take advantage of the single market and the banking union, if not to be as a prudential reality where banks can operate their capital liquidity, or to have that in a single jurisdiction as Europe, to allow for the free flow of capital and liquidity. In that vein, we do support also completing the banking union by having a first step at least towards a common deposit insurance, which we see perhaps as the first step to be a provision of liquidity in the form of reinsurance scheme. Another core theme of the EBF is limiting the burden of regulation and supervision, and I maybe highlight the concerns with some of the provisions proposed by the Commission on the general prior permission for redemption of MREL, which would be very burdensome. I think we propose this could be maybe limited at least only in cases where one would breach MREL. And then still we have concerns with Article 55 for the contractual clauses to be put in every instrument, which we would like to see really limited to MREL itself. I think having new priorities doesn't mean we should give up on old priorities. I think it's necessary also for us to recall some of the old principles that are still valid today, and I'm thinking about safeguarding continuation of critical service and access to deposits, and also preservation of shareholder value. And there's maybe 2 points I would like to mention with regard to the pre-resolution moratorium tool, which we see as really undermining maybe this maintaining this access to critical functions and deposits, and perhaps maybe being also a financial stability concern and hastening the demise of a bank that is still in recovery. So we would like to see that hopefully limited with the international agreed 48-hour time frame, and maybe to limit it also to the failure or likely to fail trigger. And maybe my colleagues will talk more about the MREL breach, which is currently an automatic trigger of the MDA restrictions, which we also see have some financial stability implications that could diminish also the shareholder value. And here too, we think we could take a step back and still, while this might be an option, keep it as a non-automatic option, because there might be more proportionate ways to address this. So, and finally, I think maybe also worth mentioning that we are very happy with the creditor hierarchy directive, how fast that has been passed. I think that's a very important piece of legislation that will help banks to meet some of the subordination requirements. We hope they won't be too high. We would also like to see some more stricter eligibility requirements, because I think we are in favor of having bail-inable liabilities that are beyond question bail-inable, but I think we have concerns about the current stock of MREL debt that is out there to still be eligible tomorrow, at least until we reach that new state. So I think the grandfathering provisions, I think, being well accepted already, I think that's great news. And so I think I'll stop here, because I think that's our key messages, but I think the banks here today, I think, will be much better in a position to give some technical detail to what I said, and I hope they remain in line with our position. Thank you very much.